Inflation, recession, and bears. Oh my. You may have heard that the stock market just went into a bear market. So what is a bear market and should you be scared of one? Hi, I'm Steve Wershing, CFP with Focused Wealth Advisors, and welcome back to 30-Minute Money. Yes, it's May 20 as I record this, and the stock market today crossed over the point at which those in the know say that it crossed over into a bear market. So what is a bear market? What's a bull market? And what should you do about it? Well, if you know anything about stocks or read anything about stocks, you know about bulls and bears. Bull market is when the market is generally in an uptrend, and a bear market is when the market is generally in a downtrend. And a bear is not just when the market goes down a bit, but it's a matter of degree. If the market drops by if the broad indexes drop by about 10%, it's called a correction. And if it drops by more than 20%, it is said to be into a bear market. Fun fact, it's called a bull market because bulls attack by going up, and it's called a bear market because bears attack by going down. It's always the attack because although we've gotten a little bit better, there is still a lot of testosterone that flows around the investment business. So everything's got to be an attack. Anyway, so bulls attack up, so the market is going up in a bull market, and bears attack down. And so that a bear market is when things are going down. Now, one thing that it's important to realize is that going up and down is stuff that happens all the time. The market, whether it's in an uptrend or a downtrend, never does it smoothly. It's always going, there's always bumpiness, there's always going up and down. And part of that is because the market almost universally overreacts to news as it comes out. So if there's a particularly good piece of news, the market may zoom up, but typically it will sort of calm down a little bit over the next succeeding period. Similarly, if there is a particularly bad piece of news that comes out, it may go down quickly, but then not uncommonly it will sort of work its way up. But when the downturns, when the downdrafts exceed the updrafts, and it begins to go down over the course of time on average, and it develops a trend, that's called a bear market. Now, corrections happen pretty frequently, but corrections happen on average, they've happened about every 19 months since 1928. Bear markets, because of the degree, happen less frequently. We have had 14 bear markets since April of 1947. And because they reflect a trend, bear markets tend to last longer than just a little glitch. We've had some that have been as short as 1 month, but I would argue that that's not really a bear market because, again, a bear is supposed to be a trend, and typically they will go a lot longer than that. So the shortest, smallest one has been something like 20.6% in a very short period of time. They've been as big as 51.9%. They average about a year, about 349 days on average, and they take the market down an average of 36.3%. So a couple things to think of when you hear that. First is you will hear a lot of people say buy the dip. When things go down a little bit, buy lower, which is a good idea to buy lower. But you don't necessarily want to commit too much just because we've crossed into bear territory, because again, a bear is often a trend, which means it's headed downward, and it will probably continue doing that for a while. So it doesn't hit a bear, doesn't become a bear until it hits 20%, but the average is 36.3%. Now, you may hear that some bear markets have been as severe as down 89%. 89% is how far the market fell in 1929. But we can't really use that in the modern as a comparison to what goes on today, because that downturn, that crash in 1929, led us to all of the securities laws that are in place now. Those securities laws were passed in response to the market crash of 29 and the Great Depression of the 30s. And those laws were enacted in 1933 and 1934. So we really should, for our purposes, we want to go back maybe into around 1940 to take a look at things, because that is when we have the current day regulatory framework in place, a lot of which was done to prevent huge 90% bear markets and subsequent depressions. The worst one in recent memory, may not be recent for many of you, but in recent memory, the last big one was 2007 to 2009. It lasted about 1.3 years, and it took the markets down about 51.9%. So now that you've got a little bit of background on what a bear market is, the question is, should you be scared, and what should you do? Okay, so there's not a good reason to be scared that we are in a bear market just because we're in a bear market, because the market is cyclic. It goes up and it goes down. The fact that it has crossed over 20% and everybody is now talking about being a bear market, it doesn't mean the world is coming to an end. It doesn't mean that it will suddenly go to zero. It won't. But we should be prepared for it to go down a little bit further, because now that it is a bear market, if it stays in bear market territory, even if it just goes down the average, we've got another 16% decline to go. What does it mean? Well, what it frequently means is that we are headed into a recession. Down markets don't cause recessions, but the stock market is a leading economic indicator. And what that means is that it's a harbinger of what may be coming down the road. Most bear markets were associated with subsequent recessions in the economy. It's not always, but most of the time, it is a leading indicator. And if we look at that in conjunction with the other leading indicators, we can get a sense of whether or not a recession is on the way. That doesn't mean that we're going to have a recession tomorrow. It might not be for a few months. It may not even be until next year. But more often than not, when we start entering into a bear market, and if it continues the downtrend, then it goes into a deeper bear market, then there's a pretty good chance that we may get an economic recession. What that means is you may not want to commit yourself to large purchases. You may not want to, may want to be careful if you're starting a side hustle into into your own business or something like that, because if we are in fact headed into a recession, that will mean it's harder to start a company. The success of a company has a lot more to do with the economic environment than your individual efforts. I was just listening to a fairly famous business professor talk, and he started a whole bunch of different companies. And when he looked back, he would like to believe that, he had a great idea, or that his genius in managing it really caused most of the successes that he had. But when he compared that to the economic cycle, what he found was that the economic cycle was a much better predictor of how that business did, rather than any individual thing that he did within the company. And so if we are in fact headed into a recession, if you want to start a side hustle, if you want to change jobs, if you want to go to work for a smaller company, these are things you may want to consider, because those are enterprises that may be jeopardized by our going into a recession. But the bigger question is, should you be scared? Well, it should open your eyes to a few things that you consider if you in fact are nervous. First, do you have too much stock? All portfolios for the long term should be allocated across a number of different investments, at minimum stocks, bonds, and cash. What we do here is stocks, bonds, cash, real estate, and commodities. And so the best risk management technique and the best way to take advantage of both the ups and downs in the market is to have a portfolio that is spread over a lot of different kinds of investments, or at least those 5 major categories. If you look at your portfolio and most all of it is stock, then yes, you should be scared, and you should respond by moving to a better, more reasonable allocation. Now, some people may be hesitant to do that because they may feel like, well, it's already gone down a whole lot. I want to wait until it recovers before I reallocate. Remember, we just hit 20%, and the average bear market is down 36%. So if you have too much stock, you've got another 16% or more to go before we might hit the bottom of that bear market. So it's not a bad idea to reallocate now and get out of stocks if you have too much. If you need money from your portfolio over the next 2 years, let's say you are planning a large purchase. Let's say you're thinking about buying a house, or you need to replace your car, or some other significant investment. That money, anything that you need in the next 2 years, should be in cash. It should not be invested in things that go up and down. And so if you look at your investment accounts or portfolio and you realize that yes, even this money that you had set aside for the house that you would like to buy is in stocks, it's a good idea to liquidate that now and make sure that it does not fluctuate between now and when you want to buy the house. If the bear market continues and goes a lot deeper, you may find that you don't have enough to buy that house. And then finally, a totally unquantitative way of doing it. But if you can't sleep at night, you have the wrong portfolio. If you wake up in the middle of the night nervous about what your portfolio is doing, that in and of itself it tells us very clearly you have the wrong allocation, or you don't have the right person who's coaching you on it. So if you can't sleep at night, you probably want to reduce your exposure to stocks. And even if some of your positions are down, you may want to cut your losses and move it into something that is going to enable you to be okay with it and have some peace of mind. Because if you're losing sleep now and the bear continues, then you're probably going to make a decision about your portfolio that's based on emotion, and that's almost always a recipe for disaster. So, a short-term decision to avoid the bear is not a good way to manage a long-term strategy. So, if you can't sleep at night and you're really scared about what's going on, you should probably lighten up on how many stocks you have. Now, let's say that none of those are true. What should you do now that we are approaching or into a bear market? What response should you have? Well, as I said, if you need a portion of your portfolio to make an investment or a purchase in the next 2 years, liquidate it, convert it to cash. Make sure that it's in your reserve account, not in your long-term investment account. If you have an appropriate allocation, you may want to rebalance. You may want to take advantage of the opportunity that things are down and that you can buy stocks when they're relatively lower, so that when things recover later on, that you can take advantage of the recovery. Now, I wouldn't necessarily do that right now, because again, we may still have a way to go. In fact, statistically, the long-term returns are if we look at different frequencies for rebalancing portfolios, you could rebalance weekly, monthly, quarterly, semi-annually, once a year. Statistically, less rebalancing is associated with higher returns. So twice a year or once a year are found. When we do the statistical analysis, we find that the portfolios that are rebalanced 1 or 2 times a year do better over the long term than ones that are rebalanced more frequently, like monthly. So keep it in mind. You may want to rebalance your portfolio, but you don't necessarily want to do it right now. Take a look at the individual growth positions that you have. If you are someone who invests in specific stocks, make sure that you have enough of them. The risk of being in a stock is far greater than being in a portfolio of stocks. Now, of course, our favored way of investing is through broadly diversified investments like exchange-traded funds, maybe no-load mutual funds. And a lot of those are based on indexes. And so we might have, several hundred positions in a portfolio, or a portfolio that at least mimics an index like the S&P 500 index, which is reflective of 500 different stocks. But if you've got your own investment account and you've been, fiddling around with things and buying a few things, well, you have far more risk in your portfolio than the market overall. So take a look and make sure that the growth portions of your portfolio are diversified over enough things. If they're individual stocks, you may want to make sure you have enough of them. If they're in broadly diversified mutual funds or exchange traded funds, then that's a much safer way to be. Sometimes you can adjust allocations between stocks and bonds and cash and commodities and real estate, and you can do that what we call tactically in response to market events, but that's not something that an amateur should do. That's something that takes some, a research database and some professional discipline. So if you want to work with, someone who involves tactical changes periodically, you want to do that through a professional tactical manager as opposed to you doing it yourself. If you're doing it yourself, we recommend that you do it broadly and that you rebalance periodically, that you don't try to make the little timing things unless you've got a really good, solid quantitative reason for doing it. Not just, I think the market's low, so therefore I will do this, but that you follow specific indicators and do it with discipline over the long term. Here are some better ways that you can take advantage of a down market. One is, or two of them are tax moves. So if you have something that is down a whole bunch, you can sell that at a loss and not change the character of your portfolio if you immediately invest it in something that's very similar. You don't want to go back into the same thing because the IRS has something called a wash sale rule, which means if you take a loss on a position and you reinvest in that same position within 30 days, they disallow the loss and you can't claim it when you file your taxes. But let's say, for example, that you have the Fidelity Index 500 fund and it's down a whole bunch and you want to take some of those losses, you could sell some of that or all of that fund and move it into the Vanguard 500 fund. So it's the same basic index, it's the same kind of investment, but technically it is a different investment. So you get to realize the loss on the Fidelity fund and establish a new cost basis in the Vanguard fund. So that's one way of doing it. Another way is if you invest in specific stocks, you can let's say that you believe in home improvement and you've got some Home Depot stock and you know you have a loss and you want to take advantage of it. Well, you can sell some Home Depot and buy some Lowe's, which is the same basic kind of store. It's in the same sector, but it enables you to realize a loss on Home Depot and establish a new basis in Lowe's when you invest in it. Now, please understand, I'm not recommending that you invest in those Fidelity funds, those Vanguard funds, Home Depot or Lowe's. I'm just using them as examples, but that's how you can take advantage of a tax loss to potentially offset some gains that you may otherwise have to realize this year. Here's an even better one. If you do not have enough money in your tax-free bucket, if you take a look at your portfolio and you see how the money is balanced between your taxable account, your tax-deferred accounts, 401ks, IRAs, those kinds of things, and tax-free accounts like Roth IRAs and things, and you have a lot in the deferred account, but you don't have as much in the tax-free account, doing a Roth conversion when things are down can give you a bigger benefit than just the conversion. So let's say that you had a mutual fund or an exchange traded fund that was at $10,000 a little while ago, and now it's down to $8,000 because the market is down 20%. Well, if you liquidate that in your IRA, convert it into your Roth IRA and reinvest it in that same fund in the Roth IRA, you've done an $8,000 conversion. You'll have to pay tax on that $8,000. However, when the market recovers, that will go back up to, we hope, the $10,000 you had before and then continue on its merry way. So when the market is depressed, it can be a great time to do Roth conversions because over the long term, you end up getting a somewhat bigger bang for your buck because you're not only taking advantage of the tax code, you're taking advantage of the market ups and downs. So what should you put on your 30-minute action list? Okay, here it is. Take a look at your overall allocation. Make sure that you have a balance between stocks and bonds and cash and commodities and real estate that makes sense for you, your risk profile, your time horizon, and the goals that you're saving for long term. To make sure that any significant purchases that you want to make in the next 2 years, you have set aside in cash and not invested for the long term. Review your asset location, meaning how much do you have in that taxable account, the tax-deferred account, and the tax-free account. And then look at the positions that you have in your taxable accounts and see if there are any opportunities to do some tax loss harvesting for any profits that you've made previously this year or may make later in the year. If you're not sure if you have the right allocation, or if you have any questions about these topics, you're welcome to give us a call or contact us. You can go to focusedwealthadvisors.com/contact. You can schedule a no obligation 15-minute call, or you can fill out the form and let us know how to get a hold of you. We're happy to talk about whatever question is on your mind. You know, we want to make sure, client or not, we want to make sure that we do whatever we can to make sure that you're making good decisions and not about to make a mistake. So please feel free to reach out. We're happy to answer any questions you have. Thanks for joining me. I'm Steve Wershing from Focused Wealth Advisors, and I will see you next time on 30-Minute Money.